Exercise 12-8 will take us through an example of an allocation of a partnership loss. Allocating profits and losses among partners can be challenging and can be a major source of disputes. Any division of profits and losses is allowed as long as the partners agree and it's in the partnership agreement. So as noted earlier, when you form a partnership, you go into your lawyer and you very simply create a partnership agreement as to how you're going to allocate net income and loss for the years. And that is a binding agreement as long as that partnership is in place. In the event that the partners have not drawn up an agreement, or if the agreement does not state how the partners will divide profits and losses, by law, the partners must share profits and losses equally. In some cases, an equal division of income is not fair because one partner may perform more work than the other. Keeping in mind the allocation of income for purposes of partnership financial statement is we need a mechanism by which we can allocate the income or loss of the business to report on the respective partners' tax returns. And that is why we go through this step of allocating the partnership income. In exercise 12-8, we have Oscar and Elmo. They've formed a partnership and they've invested $50,000 and $70,000 respectively. So that $50,000 and $70,000 is our opening capital numbers. For a combined total of $120,000. Next, we're going to work through how they share their profits. As noted earlier, the allocation of profits could be equal. It could be an agreed upon percentage split. It may incorporate an allocation based on initial investment. It may include an allocation of equivalent to service because one partner works in the business more than others. There's no set rules. There can be multiple allocations. Keeping in mind that if there's an intent or a need to change the allocation, the partnership does have to be changed legally to reflect the change in allocation because that partnership agreement is your legal binding agreement that supports the income reported by the partners for the year on their personal tax returns. The partnership itself does not file a personal tax return, but the individuals do. So going back to allocating our profits, Oscar is to receive an allocation of $25,000 for his service and Elmo is to receive $15,000 for his service. So this is the equivalent to them receiving a salary if they were actually an employee of the partnership, but generally partners are not employees of their own partnership. So this is the equivalent to what they will receive in lieu of receiving a salary. This is their considered worth of their effort on an annual basis for the work. It then says the next $12,000 is to be allocated according to the original capital contribution. So we're going to allocate $12,000 based on the original amount of capital that Oscar and Elmo contributed. So Oscar originally contributed $50,000. Elmo originally contributed $70,000 for a total of $120,000. $50,000 divided by $120,000 is 41.67%. So we will take the $12,000 as stated in the partnership agreement and multiply that by the 41.67%. We will take the $12,000 We'll then take the $12,000 and multiply it by Elmo's share, which is $70,000 divided by $120,000, which gives us 58.33%. We've allocated $12,000 based on the original capital contribution. The third parameter around allocation is the remainder is to be allocated 5 to 4 respectively. So for each 5 parts of income that Oscar gets, Elmo receives 4. So we're going to use a factor of 9 to allocate the remaining. What is the remaining? It says here that we have a loss of $11,000, but yet we've allocated $40,000, we've allocated $12,000. So we have allocated the following. We've allocated an equivalent salary between the two of $40,000. We've allocated based on opening capital, as noted in the partnership agreement, we've allocated $12,000. So we've allocated $52,000 worth of income, but yet we have a loss of $11,000. So we have over allocated $52,000 plus $11,000. We have over allocated $63,000. So we've over allocated to income $63,000. We need to split the $63,000 5 to 4 so that our end result is an allocation of $11,000 loss. We said 5 to 4. So we're going to take the 63,000 and divide it by 9 and multiply it by 5 for Oscar's portion. We're going to take the 63,000, divide it by 9, multiply it by 4 for Elmo's portion. Remembering that the 63,000 has been an over allocation of income, so it's going to be a negative on our schedule. So we're going to take the negative 63,000, multiply it by 5, divide by 9, which is a negative 35 of 63 for Oscar's portion. We're going to take that same allocation, over allocation of 63,000, divide it by 9 and times it by 4 for Oscar's portion. So we have allocated $63,000 in loss in order to balance to our overall loss of $11,000. So our goal when we set out to allocate the income was, how will we allocate that loss of $11,000? But within the partnership agreement, we're told that the first $40,000 gets allocated to the individuals. The next $12,000 gets allocated to the individuals. And then we have to balance to what our actual income or loss was. In this case, we had a loss of $11,000. So we needed to reduce proportionately income of $63,000 based on a 5 to 4 split, so that we balanced at that $11,000. In closing, the question doesn't indicate any withdrawals or drawings in this case, so we have an opening balance of $50,000. Oscar shares in $5,000 worth of overall decrease in his capital, so his ending balance of his capital is $45,000. $50,000 less 5 gives us $45,000. With Elmo, he starts with opening capital of $70,000. His share of the $11,000 loss is $6,000. So his ending capital is the $70,000 less the 6 to give us $64,000. Overall, we started with $120,000 of capital. We had $11,000 loss, remembering that losses decrease capital, income increases capital. 120,000 less 11 gives us a 109. All of these steps were necessary to balance to this 11,000. We couldn't just take the 11,000 and divide it 5 and 4, because the partnership agreement had set out that there's an allocation based on service. There's an allocation based on original capital. And so this 11,000 becomes what we need to balance to in order to support the split of partnership income for the personal tax returns. So on Oscar's personal tax return, he is going to show a $5,000 loss for the year from this partnership. Amal is going to report a $6,000 loss on his personal income tax return for his share of the partnership income.